Welcome to the February 2026 investment strategy, where we break down the equity market performance, key global and domestic developments, debt market outlook, and most importantly, our investment strategy and model portfolios for different investor profiles and risk appetites. I'm Sharvari from the Investment Solutions team.
And I'm Vishad.
If you've been watching the markets lately, the January 2026 was quite a ride. Am I right, Vishal?
Yeah, absolutely, Sharvari. And that's why today we are here to break down everything that happened last month and what it means for your investments going forward. We've got a lot to cover, from global central bank moves to some truly landmark trade deals that could reshape India's growth story. Whether you are a seasoned investor or just getting started, this one's for you.
Let's start with a big picture. January 2026 was not kind to equity investors. The market saw broad-based correction and almost no segment was spared.
Here's what the numbers look like. The Nifty 50 and Nifty 100 are large cap benchmarks. Both fell around 4.5%. But if you were holding mid caps or small caps, the pain was sharper.
Mid caps dropped nearly 6% and small caps fell almost 8%. This tells us something important. Investors were moving away from riskier bets and becoming more cautious.
Now, when we look at sectors, only two managed to stay in the green. Metals up about 1% and defense barely positive at less than 1%. Everything else was red.
The hardest hit? Real estate stocks fell over 13%. Consumer durables dropped about 7.5%. Auto stocks were down 7%. So this wasn't a clear rotation for one sector to another. It was more like a broad risk-off move combined with profit-taking.
Well said, Sharvari. And here's the context that matters. Foreign investors, the FIIs, continued their heavy selling. In December 2025, they pulled out about 34,000 crore rupees. In January 2026, that number jumped to over 41,000 crores.
That may be true, but Vishal, here's the silver lining. Domestic investors stepped up in a big way. DIIs pumped in nearly 70,000 crores in January alone. That kind of support helped cushion the fall.
On valuations, the Nifty 50 forward price to earnings ratio has come down from its October 2025 peak. It's now around 21 times, which is still about the 3-year average of about 20, but definitely more than reasonable than we were a few months ago. That's a wrap on the equity market performance. Sharvari, please get us started on global developments next.
With pleasure, Vishal. Let's zoom out and look at what's been happening globally, because these developments have direct impact on our markets.
January was eventful on the global stage. We saw geopolitical headlines around Venezuela and Greenland, ongoing tariff discussions, and a major development around the U.S. Federal Reserve.
There were reports that Kevin Warsh might be appointed as the next Fed chair. Markets interpreted this as a signal of a more hawkish approach to interest rates, meaning rates could stay higher for longer. Vishal, can you give our viewers deeper insights into the immediate reaction?
The immediate reaction, Sharvari, was that the US dollar strengthened and precious metals sold off sharply. Gold dropped 7% and silver fell 10% in a single day. That's a significant move.
It sure was. Meanwhile, the Bank of Japan held its benchmark rate steady at 0.75%. This is the highest level since 1995. But they're clearly not in a hurry to tighten further. They're watching wage growth, inflation, and currency movements carefully. Right, Vishal?
Absolutely. And from a growth perspective, the IMF's latest projections show global growth holding steady at about 3.3%. India remains the fastest growing major economy with a projected growth rate of 6.4% for 2026, ahead of both the US and China.
Now, Vishal, why not take our viewers through what really matters for Indian investors? This part is important, so let's take our time here.
Indeed, Sharvari. To start, three major developments shaped the domestic narrative in January. The landmark free trade agreement with the European Union, the announcement of the India-U.S. trade deal, and the Union Budget 2026. Each of these is significant, and together, they set the stage for India's medium to long-term growth story.
Let's start with India-EU Free Trade Agreement. This is a historical deal. It connects two massive economies into a combined market worth $24 trillion. What does this mean practically though, Vishal?
It means that over 99% of India's exports now get unprecedented access to European markets. On the other side, India gets preferential entry across 97% EU tariff lines.
And here's what's smart about this deal. It protects sensitive sectors, dairy, cereals, poultry, and certain agricultural products still have policy protection. So, India isn't exposing its vulnerable sectors and is simultaneously opening up its strengths.
That balance is important for social and political stability, right, Sharvari?
Yes, correct. What's more, the sectors that benefit most are labor-intensive exports, textiles, leather goods, marine products, footwear and gems, and jewelry. These industries could see significant export growth, Vishal. Why don't you take us through the impact on the services side?
Sure thing. On the services side, the EU has made a deep commitment across 144 subsectors. This ensures stable access for Indian IT companies, professional services, education providers, and business service firms. Sharvari, this seems like the right time to discuss the India-US trade deal's impacts.
Sure, the India-US trade deal was announced on social media while product-level details are still awaited. The headline is significant. Tariffs on Indian goods going to the US are expected to drop from 50% to 18%.
That's a massive reduction. It removes key element of global uncertainty that had been hanging over exporters and businesses. Lower tariff means lower costs, which supports competitiveness and ultimately economic growth.
The agreement with EU and the trade deal with US trades agreements are structural positives. They don't change things overnight, but over the medium to long term, they strengthen India's position in global value chains and reduce dependence on single trading partner.
That brings us to the third major impactful event in the India story.
That's right, Vishal. The much-awaited Union Budget 2026. This budget came at a time of global uncertainty and government made a deliberate choice. No populist measures, no large subsidies. Instead, the focus was squarely on long-term productivity-led growth.
The budget rests on three pillars: manufacturing, services, and infrastructure. These are the engines that drive sustainable economic expansion, and the government is investing in all three while maintaining fiscal discipline.
Speaking of fiscal discipline, the fiscal deficit target for the next financial year is 4.3%, down from 4.4% this year. That might seem like a small improvement, but it signals commitment to keeping fiscal deficit path on track.
Sharvari, if you notice, there is also a forward-looking element here. The budget aligns with global trends in artificial intelligence and technology through the launch of India's Semiconductor Mission 2.0. This initiative aims to strengthen the domestic capabilities in semiconductor equipment and materials. What other highlights caught your attention, Sharvari?
The points I found worth noting include a 10,000 crore rupee equity-based SME growth fund to support small-medium enterprises, continued infrastructure spending, and the Biopharma Shakti strategy to advance healthcare innovation.
One change that traders should note: the securities transaction tax on futures and options has been raised from 0.02% to 0.05%. That's a meaningful increase for active derivatives traders.
Taking a step back, the combined impact of these three developments, the EU FTA, the US trade deal, and the growth-focused budget, creates a strong foundation. These aren't quick fixes. They're structural changes that should support India's growth trajectory over the coming years. That summarizes the India story for this month. Vishal, would you like to touch upon the debt market updates?
Yes, Sharvari. And I want to throw light on the bond market and fixed income products here. This is an area many retail investors overlook, but it's equally important.
On inflation, the consumer price index rose to 1.33% in December. That's up from 0.71% in November, mainly due to base effects wearing off and food prices stabilizing rather than falling further.
Wholesale inflation also turned positive at 0.83% after 2 months of deflation. This was driven by higher prices for manufactured products, minerals, and textiles.
On the positive side, industrial activity is picking up. The index of industrial production came in at 7.8% growth in December, the highest in over 2 years. Manufacturing, mining, and electricity all contributed to this strong performance.
Now, bond yields. The 10-year government bond yield rose to 6.76% after the budget announcement. The main reason? The government's market borrowing plan for next year came in higher than expected at over 17 lakh crore rupees. You know what that means, right, Sharvari?
Sure do. Higher government borrowing means more bond supply, which tends to push yields up. However, the government's commitment to fiscal consolidation and the RBI's liquidity management should help contain any sharp moves.
The RBI has already cut the repo rate by a total of 125 basis points, but transmission to market rates has been limited. The central bank is expected to focus on ensuring these cuts actually flow through to borrowers.
So what does all this mean for our viewers' portfolio, Vishal? Shall we talk about the strategy?
100%. For equities, valuations have eased from their peaks. The recent policy developments, the trade deals, and the growth-focused budget are expected to support markets over the medium to long term. This creates an opportunity to increase equity allocation.
Our recommendation is to maintain your large cap holdings while also adding exposure to mid caps and select small caps in a staggered manner. Don't put all your money at once. Spread your investments over time to average out volatility.
One important addition to what Sharvari said, precious metals. Gold and silver should be a part of your portfolio, but think of them as a hedge against uncertainty rather than a return-generating asset. They recently corrected from all-time highs, which could be a reasonable entry point.
For fixed income, current yields are attractive. The strategy is to focus on accrual funds and short duration strategies that capture these yields. You can also consider a tactical allocation to dynamic bond funds to benefit if longer-term yields ease.
In the near term, equity market will be influenced by the current earnings season. The full impact of trade deals and budget measures will play out over time. Patience and discipline will be key. That's it for part 1 of the February 2026 investment strategy. We'll see you in part 2 soon, where we bring you 6 model portfolios, namely aggressive, moderate, conservative, regular income, thematic, and aggressive portfolio with alternative investments that are based on your investment profile and risk appetite.
Mutual fund investments are subject to market risk. Read all scheme-related documents carefully before investing.